Thank you for joining us for the North Berkeley Investment Partners fourth quarter market update. I'm Brian Kozel, partner and lead advisor at our firm, and I'm joined today by one of our founding partners and current Chief Investment Officer, Kate Campbell-King. Today, we will recap the markets, share our perspective, and review some of the questions that we've heard from clients over the past quarter. If you'd like to have a conversation about your specific portfolio, please contact your advisor, and we look forward to talking with you. And with that, I'll turn it over to Kate to get us started.
Thanks, Brian. The primary thing that I thought we should talk about today is something I've observed in the news recently. And that is that the media, when they report on the market, when they report on the economy, report on what's going on, their focus is really on trading rather than investing. And they talk about how a particular stock is behaving on a particular day. Might be because they're reporting earnings or there's been some other news about the company. And they talk about, is this a good time to buy? Or is this a good time to sell? They'll talk about currency markets or China or the trade war, all with an eye to, well, what should you be doing? What should you be trading? For us, we're not interested in responding to short-term news cycles. We know there's a lot of noise in the price of stocks. And, if you're going to be active with stock trading, it's not likely to be very beneficial for your portfolio.
Actually, on that point, we were just talking about a 2011 study that was done on exactly that, on how much value do you create by being more active in the markets. There's actually a study done on these sorts of behavioral patterns and resulting performance by two professors, Dr. Brad Barber from UC Davis and Dr. Terry O'Dean from our very own UC Berkeley. They looked over a 5-year period, and the conclusion was that the 20% of traders that were most active were outperformed by more than 7 points per year by the 20% of traders that were least active, which gives more credence to that slow money buy and hold approach.
Yeah.
That is how we think about investing.
And I bet the difference in 7 percentage points was that significant because the active traders were actually negative.
Mm-hmm.
So, interesting. And in terms of the way that we structure portfolios, we work with managers, in some cases who are replicating an index that's very diversified, where we want exposure to a broad group of companies, very low turnover. And in other instances where we do have an active manager, but they're not active traders. They're active investment managers. And I think that's really a crucial piece of the way we put that portfolio together. And, the way that we handle repositioning really is through rebalancing. And what rebalancing does is when the markets have gotten very high, or a particular area of the market or asset has gotten to be very highly priced, we sell a little bit of it. We're an incremental seller at the margins. And we use those proceeds to buy a little bit of something that hasn't done as well and is at a lower price. Over time, that adds up to more significant growth, and it gives you less volatility along the way.
I want to re-emphasize what you just said there, and I think it's really important around the concept of rebalancing as a key way that we manage portfolios, because it is a systematic way that we can buy low and sell high, rather than get caught up in the short-term media news cycles, what a stock or a market has done in the last 6 hours or 6 minutes. Rather, we're rebalancing to our target, to a strategy that we agreed on with our clients as what we want for the long term. When we get a little bit above that, we can trim the portfolio back. When risks have entered the market and the portfolios decline a little bit, we're buying. We continue to recenter to that long-term goal.
Yeah, that's right. And when people get excited about something, when the stock has gone up in price or a market has gone up, they want to buy. And when it's gone down, they're worried and they want to sell. So they buy high and sell low. And rebalancing does the exact opposite. Much healthier for the portfolio. And speaking of health, what about the health of the market?
Well, as this is a mid-quarter call, at exactly mid-quarter on November 15th, the U.S. stock markets, both the S&P 500, the Dow, and the NASDAQ, all hit new all-time highs. This was widely reported in the media, celebrated as the growth in this market has been robust. But we also understand that that has not necessarily always been the case. We only need to look back to last year, 2018, where each of the various asset classes that we follow all had negative returns on the year, with the only exception being U.S. bonds, which were flat at exactly zero on the year. So it's actually quite a stark change to flip to this year, where we've had quite strong returns. The S&P 500 being up 26.7%, international stocks, as measured by the IFA, adding another 18.2% on the year. The bond market, as I mentioned, with a 0% return in 2018, has come back to return 8% this year. And the last piece that I'll call attention to is real estate, which continues to be a diversified part of our portfolio. After having a slightly negative year last year, has shifted with lowering interest rates to return a little bit more than 26% this year, adding to the overall growth of portfolios and leading the way along with U.S. stocks. There's a couple themes that we're paying attention to that we think are driving a lot of this change in the market. The first is the ongoing negotiations between the U.S. and China and how that impacts our growth here, growth in China, and really growth around the globe. Right now, the market is optimistic that a deal will get done and has been pricing that in, but no deal has yet been signed. We continue to pay attention on that front. The second piece is interest rates. After raising interest rates more than 7 times over the past 2 years before 2019, the Fed has reversed course and lowered interest rates a few times this year, 3 to be exact. That has helped bonds, but also has significantly driven the return that we've seen in real estate in the portfolios. Another reason that we keep the portfolios diversified to take advantage of these types of opportunities. And then the last piece that I'll touch on is geopolitics. And it seems to be everywhere as we look in media and conversation. We don't make portfolio decisions necessarily based on any specific outcomes, whether that's the US election that's coming up next year, unrest in Hong Kong, the ongoing Brexit dance between conservatives and Labour, that we will maybe see a resolution to at some point. The market could certainly be shocked from this area, but at the end of the day is not pricing in any significant concern at the moment, and our portfolios remain diversified and resilient. So on those 3 themes, we think the portfolios are well positioned and continue to see and benefit from the growth that we've had in the stock market this year as a recovery from last.
So knowing that the market is at all-time highs, especially with the backdrop of gradually slowing economy in response to which the Fed has lowered interest rates, another issue arises for us as we think about the management of portfolios, and that is, when do you sell? If your overall investment strategy is to buy quality investments and to hold them rather than jumping in and out of the market, the key decision you face is, when do you sell? And in general, if you've got a high quality investment, it might be a single stock or a mutual fund, and it's got significant appreciation on which you would pay taxes were you to sell, we always want to be very careful about that. If a stock is at an all-time high, however, and particularly if it's been trading significantly above its historical trend line of growth, it can be a good time to sell. And that brings to mind actually a timely opportunity. As we approach year end, many clients have been pinging us about tax planning and also planning for charitable donations. And in today's market, we have the possibility of an ideal combination of circumstances, which is a highly priced asset, perhaps an individual stock, a desire always to reduce taxes, and the desire to do some year-end charitable giving. And so the opportunity is that we can take that low basis stock or other asset and donate it to a donor advised fund. Oftentimes, particularly with an individual stock, it may be something that a client has held for a long time. It may be something they inherited. It may have a significant component of family legacy to it, where in addition to not wanting to pay taxes, people don't feel comfortable letting go of something that really is a part of their family. And so the opportunity here is to avoid those taxes and to retain the family legacy opportunity or the family legacy component. If you move that stock into a donor advised fund, you get a tax deduction. You avoid paying tax on the gain, and you create a pool that remains available to you and your family over time for giving in whatever way is appropriate in your family. So depending on how much you sell and how much you donate, the entire transaction can end up being tax neutral. And then you have a pool of proceeds from the sale as well as a pool of charitable funds for the future.
It's a good point, Kate. And I will simply add on that we have also seen opportunity to do this with clients who have shares of stock through their employer, whether stock options or restricted stock units that they were granted as part of compensation, or even, as we've talked about, strong growth in portfolios and markets this year, a highly appreciated portion of your core portfolio can have tax benefits in the same donating strategy to a donor advised fund.
If any of our listeners out there are interested in one of these strategies, please do be in touch. Thanks for listening and have a wonderful holiday.